Hey cousins, back with another video. There's a secret phrase hidden somewhere in this video. Spot it and you might be one of the lucky winners. So stay locked in. Over the past 5 episodes, we've laid down a solid foundation in your trading journey. We've explored the core elements or principles that influence the markets, from public sentiment to economic activities to global events. We've also covered essential technical basics like understanding pips, the role of a broker, candlestick patterns, lot sizing, spreads, leverage, and other fundamental terminologies every trader must know. Your continued support on every upload has been incredible, and I'm truly grateful for this community we are building together. Now it's time to step it up. Starting today, we're entering a new phase, intermediate technical analysis. This is where the shift really happens, from knowing about trading to actually becoming a trader. On this episode, we'll begin by exploring two of the most underrated yet powerful concepts in trading, and they are time and price. While many traders focus on indicators and patterns, few understand how time and price dynamics shape the market. These concepts are often overlooked, even by seasoned traders. By learning them early gives you like a significant edge. Mastering how time interacts with price allows you to identify high probability setups, understand the market rhythm, and spot entries with precision. Whether you're just starting out or looking to sharpen your edge, this is where theory meets application. Let's dive deeper into the art and science of timing and pricing the markets like an actual pro. Understanding market sessions and time-based volatility. The global financial markets operates in structured blocks of time corresponding to major financial centers around the world. These time blocks ensure that liquidity, volume, and volatility are distributed across the trading day, depending on which region is active. There are 4 major financial hubs that drive the global markets. Number 1 is London, that's for Europe, New York for America, Tokyo for Asia, Sydney for Australia. Each of these regions contributes uniquely to the global market activity, opening at different times based on their respective time zones. The market becomes particularly active during the prime trading hours of these regions. As institutional traders, banks, and corporate initiatives initiate large volume of trades. Personally, I focus on the London and the New York trading sessions. Historically, these 2 sessions are the most volatile and liquid, making them ideal for day traders and scalpers like me. London sessions open at 8 a.m. BST, that is British Standard Time, and closes 5 p.m. British Standard Time. New York session opens at 2 p.m. British Standard Time and closes 11 p.m. The overlap between the London and the New York sessions, particularly from 2 to 5, is considered the most active and volatile period in the markets. This is when both major financial hubs are live and trading volume spikes as a result of high institutional participation. Additionally, the New York Stock Exchange, which is the largest exchange in the world, opens during this overlap, further increasing trading activity. Most traders can capitalize on the rapid and often explosive price movements during this time period by planning their entries and exits with utmost precision. Understanding the timing of these sessions and how they affect price movements, how they move, is definitely crucial to building and consistently having your trading strategy going. Time creates structure in the day. Price doesn't just move without reason. It respects time-based structures. Many trading strategies, especially institutional ones, are based on session open, session closes, and specific time windows, example kill zones. These times often act as a catalyst for significant moves. For example, the London session opens by 8 and often brings in the first wave of volatility for the day. New York opens by 2 p.m. BST and tends to continue or reverse the London trend. Then the New York Stock Exchange opens by 2:30 BST, frequently sparking a surge in market activity. Then repeating patterns allow traders to plan ahead by knowing when the market is likely to move. You can position yourself before the market begins, improve your timing, improve your entries, and ultimately improve your risk management. News and economic data are time-based. Major market-moving news such as interest rate decisions, employment reports, inflation data, and so on are released at scheduled times This event often cause sharp, unpredictable price swings. Understanding this timing allows traders to either avoid high-risk situations or prepare to capitalize on volatility. Major market moving news such as interest rate decisions, employment reports, and inflation data are released at a specific pre-announced time, giving traders the opportunity to prepare in advance. Some of the most impactful examples include US non-farm payroll. It's called NFP and released at 1:30 p.m. on the first Friday of every month. This report reveals job creation data and often causes explosive moves across USD pairs and equity indices. The next is FOMC statement, usually announced at 7 o'clock or 7:30 BST. This statement reflects the Federal Reserve's stance on monetary policies, influencing everything from interest rates to market sentiment and so on. Then the third I want to touch on is CPI, also called inflation data, GDP report, and so on. Interest rate decisions from central banks like ECB, BOE, RBA can also lead to massive price volatility across global markets. These events don't just cause movement, they reshape short-term market structure, induce fake-outs, and trigger massive liquidity grabs. For retail traders, understanding this timing is essential. You can either avoid entering trades during high-risk windows to protect your capital, or you can prepare strategically to trade the volatility and catch sharp directional moves. Trading blindly during these news releases without a plan is like walking into a storm unprepared, but knowing the calendar gives you an edge. I strongly advise not trading the news for new traders. Intra-day patterns are time-driven. Every trading day shows pattern that repeats based on time. Morning spikes during session open, midday consolidations, afternoon breakouts or reversal. By observing these time-based behaviors, you understand not just where price might go, but where it's likely to move, giving you a tactical edge in your trading over other traders. Price is not random. It moves with purpose, often aligned with time. Learning how the time affects liquidity, structure, volatility, and psychology can transform your trading strategy from reactive to proactive. Mastering the time-price relationship is one of the key factors that separate experienced traders from beginners. We've come to the end of this video. If you got value from everything I've been saying, or if you watched my previous videos and you've gotten value, make sure to like, subscribe, and comment, and I'll be sure to give you a response. If you have any questions, reach me in my DMs on Instagram or drop a comment below. That being said, make sure you keep practicing, make sure you keep getting better as a trader, and play the game to win. See you in the next one, guys. Peace.